On today's episode of the Cryptoverse, does the drop in the Bitcoin price mean that the mining network is at risk of collapse? Why has Bakkt, our savior, been delayed? And why do the UK regulators want to ban crypto derivatives? Those are the topics that I would like to cover in today's video. Before we get into that though, if you're new around here and you would like to get rid of the ads, support the show, and earn cryptocurrency rewards every day, please visit the website, thecryptoverse.show. If you click on that big blue button there that says Get Paid to Watch, there is a 2-minute explainer video that will explain to you exactly how to support the show, earn cryptocurrency rewards every day, and get rid of the ads. What could be better than that? For now though, we're going to get into the video. So this Chinese crypto mining FUD, fear, uncertainty, and doubt. Manipulation or reality? So this happens almost every time we get a crypto bear market. The same old discussion starts up, which is, oh my God, what if Bitcoin drops to the point where it's below the cost of mining, right? And it makes mining unprofitable. And this is where I kind of roll my eyes, sigh, and then I repeat the importance of getting properly educated. That's why I bust my butt making these online courses, because it took me all of 30 seconds from hearing about this FUD to getting the objective truth. So what we're going to do is, let's breeze over the FUD, just so everyone's on the same page, and then I'll equip you with a simple process that you can use yourself to get clarity in 30 seconds. So step one, we're going to go over to this article here, which has this tweet embedded into it, which shows this little video. So let's play it. Let's just take the sound off a minute. So as you can see here, we have some dude kind of wheeling out Bitcoin mining machines and then dumping them into a big pile outside of a warehouse. That's the facts of what you see with your naked eye in this video, right? But what's the meaning of it? That's the next step. So is it a Chinese mining business going out of business because they can't mine profitably anymore? Well, that's the story that's being pushed by Dovey Wan on Twitter, which is also embedded into this article. That's actually the tweet. She's like, brutal. This is what's happening now in Chinese-based mining site. 2 emojis, and she tweets out the that video there. So that's her version of the story. The author of this article, though, Tia Tam, or Mia Tam, beg pardon, suggests that this lady, Dovey Wan, is because she's the founding partner of a long-term crypto investment fund, the spreading of this FUD with the video is intended to push prices down so that the fund can buy up crypto on the cheap. So do you get that? The author of the article, Mia, is saying the author of the tweet and the person who posted the video did so because the person who posted the video owns a crypto investment fund that's a long-term view, and by spreading FUD, that would push the price down. The fund can buy up crypto on the cheap, and then over the long term, they're going to make a lot more money. That's the suggestion from the author of this article. So when you add to that the fact that Mia, the author of the article, asked this local mining company, Sihua Mining, whether the video was real or not, this fellow that owns this actual Bitcoin mining company that she spoke to, he said that the machines in the video were older versions of mining hardware that were likely just being upgraded to faster, more electrically efficient machines, if that's even a word. Energy efficient machines, let's use that phrase. So this process of dumping your outdated mining hardware and replacing it with the latest, fastest, most energy efficient mining hardware, that's a process that all big mining companies go through every 6 to 12 months or so. So those are the two perspectives. One, we could take the first line, which is, oh my God, Chinese miners are going out of business and they're dumping the hardware because it's no longer profitable. And on the other side is the exclamation, well, that's just the regular upgrade cycle and dumping the old out-of-date hardware. Those are the two perspectives. Now let's see what the actual data says, shall we? So first one we're going to look at is a 1-year chart of Bitcoin miners' revenue. Here it is. So this is at a yearly low right now of about $6.1 million per hour, which is about half what it has been for most of the year. It's been hovering around $12 million per hour, and that's shared between all of the miners. Next, let's have a look at the 1-year chart of mining difficulty. Here it is. So this goes up when more mining power is added to the Bitcoin network, and it drops when mining power is removed from the network. Now, over the last month, it's been dropping. So this adjusts every 2 weeks, which is why on the chart, you see this stepping action. It only adjusts once every 2 weeks, and then it stays flat for 2 weeks, which is why you see the flat plateaus, right? So it's adjusts every 2 weeks, and it's only adjusted down one other time this year, which you can see here if you're looking at it on the video version. So this suggests this here on the right, where you see a step down, flattening for 2 to 4 weeks, and then it's dropped again most recently. The last time it was adjusted was the 17th of November, and it dropped again for the second time in a row. So that does suggest that miners are shutting down some of their mining hardware. So it could be a mining company turning off a portion of its machines, and it could be some mining companies shutting down completely, which takes us to the final chart, which is the 1-year graph of the actual hash rate. Here it is. So this would sort of move in lockstep. There's no way to know actually whether this chart is, not at least you can't tell just from this one chart alone whether it's one mining company that has all the hash rate that's fluctuating, or if it's 100 miners which each have 1% of the hash rate each. So purely from this graph, you can't tell that, right? It's just purely the total hash rate of the entire Bitcoin network. In any case, what we see on the right-hand side here is a sharp drop throughout November, which naturally matches the difficulty adjustment we saw just a moment ago. So that's the hard data. But to be honest, it's kind of irrelevant because the mining algorithm recalibrates to match whatever hash rate is available every 2 weeks, right? It's dynamic. It's meant to work that way. So that if mining becomes unprofitable, some miners quit, it becomes less competitive, profitability rises, and that cycle just repeats itself until it returns to equilibrium. So you see this spiraling down, spiraling up situation. And generally, the Bitcoin price has a lot to do with it, because the higher the Bitcoin price goes, the more actual dollars you earn for mining a Bitcoin, which means you can pay electricity bills, buy more hardware, and so on, right? What's been odd this year, in fact, is that while the Bitcoin price has been going down, the hash rate has been rocketing until now. So the only time the mining hash rate going down is a problem, or even up is a problem, is when it's sudden and dramatic. Okay, if there's a sudden increase in mining power and it's really dramatic, or if it's a massive decrease in a very short space of time, then it's a problem. But from the data, what we looked at here, it's well within the system's ability to adapt. So that's the situation. No need for fear, uncertainty, and doubts, but you can keep an eye on the data for yourself and see if there's any risk. On to the next story. The Bakkt CEO. Why the launch of the Bitcoin futures contract market has been postponed until the 24th of January, as reported by the Crypto Globe here. So Bakkt is a big deal because it's a product from Intercontinental Exchange, the parent company of the New York Stock Exchange. Big deal. So Bakkt is designed to allow financial institutions who want to invest in crypto to do so without the complexity of buying it, storing it, managing it, and so on. As the name suggests, shock horror, Bakkt investment contracts are going to be backed by real Bitcoin, which Bakkt will purchase from the market, creating real demand and creating real liquidity. So for the crypto market to grow, we need new money flowing in, rather than what's been happening lately, which is this game of musical chairs where the same set of traders just move their money in and out of the market in an attempt to sell at a profit. That's when you go sideways, it's just money moving in and out, in and out, in and out, traders. So as I reported at the time, in fact, Bakkt was set to launch on the 12th of December, but as I stressed in that video, their official document actually said that date was pending regulatory approval, and there was a reason I pointed that out. I saw that as the most important detail, because generally we get excited about things that when we take them as certain when they're not certain, which is why I pressed that point. I'm like, yeah, take it with a massive pinch of salt. Anyway, the Bakkt CEO made a statement here about the delay, but what they said was very vague in my view. If you ask me, what they said does sound like they need more time to get themselves in line with the regulators. So there we go. On to the next story. The UK's Financial Conduct Authority, the regulators, are looking to ban the sales of crypto derivatives, including CFDs, contracts for difference, and futures. So I got this from a Forex website, fxstreet.com. UK's FCA looks to ban sales of crypto derivatives, including CFDs and futures. Now, when you hear the word ban and crypto in the same sentence, that's usually bad news, but in this case, I think it's the opposite. What the FCA, Financial Conduct Authority, intend to ban is specifically derivatives, i.e. financial instruments that are derived from an underlying asset rather than the asset itself, right? Now, banning derivatives leaves Britons with then no choice but to buy the actual bearer asset itself, which is exactly what everyone should be doing anyway, in my view. And while we already know from the old financial system, if we could ban derivatives from the old financial system, it would be a lot healthier. Now, after reading this story, I immediately thought about eToro and how they recently launched their own crypto wallet. And I actually covered that, didn't I? Now, since eToro trades CFDs, maybe they saw this coming and they started shifting over to real crypto asset trading, or it could just be unbelievably good timing. So they've launched their wallet already, as I covered, and they're going to launch crypto trading inside the app coming soon. So maybe they're making this transition from CFDs to real bearer assets, which is great because, again, if you're trading CFDs, it's not real liquidity, right? Because you're not really moving the actual assets around the crypto space. So pretty good news on that regard. It kind of links in with the Bakkt story, doesn't it? So both a thumbs up on those. If we can get to the 24th of January and launch Bakkt, and if eToro can shift over to bearer asset trading, those are both very good signs for the crypto space. But that is all I've got for you today. So if you like this episode, go ahead and hit that like button. If you disliked it, hit the dislike button. Please leave me a comment below with some feedback, and I would very much appreciate it if you would get subscribed. Also, check out the merch store, which has a bunch of merch in it, would you believe? Bearing the Cryptoverse branding. I appreciate that because your purchase from the merch store helps to keep this channel going. Other than that, I will be back with the next episode of the Cryptoverse. Until then, it's me, Chris Coney, saying bye for now.